When it comes to ParkwayLife REIT, it's also considered as one of the most stable and best performing REITs on the Singapore market. Since listing date 2007, the REIT generated total returns consisting of dividends of 390% to unit holders. This averages out the compounded annual return of 10.4% per year over the past 16 years. With ParkwayLife REIT property portfolio consisting of hospitals, a medical centre, and nursing homes, it's typically seen a defensive REIT which can consistently pay out increasing dividends year after year. But is this really the case? After all, as the saying goes, past performance is not indicative of future performance. Thus, as a unit holder of ParkwayLife REIT myself, let me share with you the good, the bad, and the risks involved in investing in ParkwayLife REIT. Fun fact, it's not as straightforward as it may seem. But let's first start with the good by looking at ParkwayLife REIT's financial performance over the past 5 years. Gross revenue, net property income, and distributable income have all grown at a compounded annual growth rate of 5.5%, 5.7%, and 2.8% respectively. In terms of NAV and DPU, they have grown at a compounded annual growth rate of 4.5% and 3.5% over the past 5 years. Although these figures aren't particularly high, it's still pretty respectable given the defensive nature of the REIT's properties. It's also useful to note that ParkwayLife REIT has experienced uninterrupted DPU growth since its IPO in 2007. This is admirable given that the REIT has gone through periods of unfavorable market conditions, such as the 2008 global financial crisis, and more recently the COVID pandemic in 2020, and the current high interest rate environment that has negatively impacted so many REITs over the past 2 years. In terms of financial health, ParkwayLife REIT is still in excellent state with its gearing ratio at 35.6%, interest coverage ratio of 11.3 times, and a low average cost of debt of 1.27% per annum. This is a REIT with ample debt headroom to pursue growth opportunities and live a higher for longer interest rate environment. In addition to steady and positive financial performance over the years, the REIT management team also has a pretty good track record. Besides delivering year-on-year DPU growth, acquisition divestments have also been accretive to unit holders. Divestments of nursing homes and non-core property in 2014, 2016, and 2021 were all done at a premium to both the valuation and the original acquisition prices. The acquisitions of various nursing homes in Japan over the years were also direct contributors to the steady growth of DPU. As a whole, from a financial and REIT management standpoint, ParkwayLife REIT performance till date is as good as any REIT investor can expect it to be. If you look into ParkwayLife REIT's future growth prospects, that things get a little bit more uncertain. As of FY 2023, hospitals and medical centre contributed 69.1% of ParkwayLife REIT's total revenue, while nursing homes contributed the remaining 30.9%. In terms of revenue growth for the Singapore hospital industry, it's poised to increase a compounded annual growth rate of about 4% from 2024 till 2028. The global medical tourism industry is also expected to grow at a compounded annual growth rate of 21.2% from 2022 till 2032. However, it's hard to predict how much of this growth will benefit Singapore as it's facing increased competition from regional countries such as Thailand and Malaysia. Let's look at the comments of C-suite management teams of healthcare companies here in Singapore, and you'll find comments such as high cost, inflation, and the strong Sing dollar have contributed to the fall in foreign patients. Foreign patients have declined as compared to pre-pandemic levels, while this has a negative impact to Singapore private hospitals' revenues. The potential negative impact will be lesser for ParkwayLife REIT due to the master lease agreement it has for hospitals in portfolio till FY 2042. As part of the agreement, there will be an annual 3% step up in total rent payable net of rebates from hospitals from FY 2023 till the end of FY 2025 as part of the ongoing renewal works at Mount Elizabeth Hospital. Thereafter, the rent payable by hospitals will either be the higher of formulas of base rent plus variable rent, or the value of 1 plus CPI plus 1% of the initial rent of 97.2 million for FY 2026, or total rent payable of the preceding year from FY 2027 till FY 2042. This means the lowest total rent payable by hospitals for FY 2027 till FY 2042 will always increase annually by at least 1%, even if the CPI is 0 or negative. In addition to the rent formula, the master lease agreement is also based on a triple net lease arrangement, meaning that ParkwayLife REIT does not bear the property operating expenses and taxes of hospitals in its portfolio. While the master lease agreement will provide a sharp boost to rental income and potentially distributable income from FY 2025 to FY 2026 due to the cessation of rent rebates, and also long-term income stability till FY 2042, I do not expect a more than 3% annual rent increase for FY 2026 onwards. Now, why do I say so? if we were to look at the revenue growth of the hospital medical segment before the renewal of the master lease agreement, you can see that annual revenue increase is below 2% for FY 2017 to FY 2021. In fact, the compounded annual growth rate of hospitals and medical center segment was only 2.6% for FY 2011 to FY 2021. It is mostly due to the previously discussed possible slowdown of revenue of Singapore hospitals. Looking at the financial results of ParkwayLife REIT sponsor IHH Healthcare, this does not really seem to be the case, as from the latest financial report, revenue for Singapore hospitals increased by 13% as compared to the previous year. A possible reason could be that ParkwayLife REIT hospitals are feeling their age and thus underperforming as a result. Until the recent refurbishment of Mount Elizabeth Hospital, the 3 hospitals in ParkwayLife REIT's portfolio have not undergone any major refurbishment since the last refurbishment of Grand Eagles Hospital in the 1990s. Thus, it is clear that for ParkwayLife REIT to continue growing distributable income year after year in the mid to long term, it has to depend on the nursing home segment or other new growth opportunities. When it comes to the nursing home segment, ParkwayLife REIT has fully focused its efforts on Japan since its major acquisition back in 2008. While that has borne fruit over the years, revenue for the nursing home segment has faltered in recent years. The 5-year compounded annual growth rate of revenue for nursing homes stands at 1.1%. In fact, there were revenue decreases in FY 2022 and FY 2023. I think the most likely reason for this will be the weakening of Japanese yen against the Sing dollar and tougher operating conditions when it comes to the Japanese nursing home industry. As seen from this chart, the value of the yen against the Sing dollar has been on a steady decline since reaching a high in 2012. Given that ParkwayLife REIT reports its financial results in SGD, revenue from its Japan nursing homes would thus be naturally lower year after year if revenue from new acquisitions or rent reviews are not able to offset the price decline between the yen and Sing dollars. To mitigate some of the FX risks, ParkwayLife REIT has in place income hedges till the first quarter of FY 2029. Before then, I think the revenue decline for the nursing home segment would have been worse. In terms of Japan's nursing home industry, it's facing its own set of issues such as increased operating costs and lack of manpower, causing many operators to go out of business. ParkwayLife REIT mitigates this by having in place built-in backup operators in most of the Japan nursing home lease agreements. Although we don't know what the exact proportion of these covered lease agreements, I also presume that rent reviews are built into the lease agreements of these nursing homes, as they're often over a long period of time and associated operating costs will likely increase year after year. With that said, investors also need to note that the incremental rent increases will likely not be a lot, as nursing homes can easily pass on these costs to their clients, as there are also societal and tax propositions to consider. Thus, while ParkwayLife REIT's strategy of acquiring new nursing homes almost every year since IPO has worked well in the past, it remains to be seen if it's sustainable in the mid to long-term future. In my opinion, for ParkwayLife REIT to continue its path of uninterrupted DPU growth, as it quickly source and secure a new term market of growth. The 10-year right of first refusal on Mount Elizabeth Novena for its sponsor could also be another avenue of growth for ParkwayLife REIT in the future. As a whole, ParkwayLife REIT's excellent performance thus far has been not a strategy of income stability and small incremental growth via the acquisition of Japan nursing homes over the years. While the income stability portion is secured for long term with the new master lease agreements for Singapore hospitals, the growth portion might see diminishing returns if ParkwayLife REIT remains to just acquiring nursing homes in Japan. On a brighter side note, investors can expect a significant one-off DPU increase of 2.9 cents for FY 2026 with the expected completion of the renewal works at Mount Elizabeth Hospital by the end of FY 2025. If I decide whether to invest in ParkwayLife REIT, its current market price of $3.49 gives it a PE ratio of 1.5 times and a 12-month trailing dividend yield of 4.23%. At these values, they are lower than the 5-year averages of both the PE ratio and dividend yield. Personally, I'll remain invested in ParkwayLife REIT at least till FY 2027 and keenly watch how the REIT executes its growth plans from now till then. Seeing how the REIT management team has performed over the years, I am quietly confident that they're able to continue ParkwayLife REIT's positive performance into the future.